from what we know of the history of capitalism, starting in Britain 3 or 4 centuries ago, and then slowly spreading to Europe and eventually the whole world, organized in a capitalist system, employers, employees, all of that, the economies crash on average every 4 to 7 years. Wherever capitalism settles in, that's what they do. It's called the periodicity or the periodization. It's called business cycles. It's called crash and boom, boom and bust. I mean, there's an immense vocabulary because this has been with us for centuries. It's part of how capitalism works. Or to say the same thing in a single sentence, capitalism is one of the most unstable economic systems you could ever see or imagine, or of which there is any historical record. Number one. Now, number two. Typically, the crash comes, not always, but typically after a period of boom, of real rapid growth that has an awful lot of people cheering on the sidelines. Wow, look at our economy grow or go. And then comes the crash. By the way, just to show you that nothing has changed, let's look at the last 3 crashes in this country. One happened in the spring of the year 2000. That was called the dot-com crash. Some of you paying attention may remember that crash. Suddenly, we were looking at a stock market which was raising the value of these dot-com companies by millions of dollars. These were companies that had never turned a profit, that had been around for years, growing slowly, but suddenly everybody thought the internet was going to revolutionize everything, and they bought the shares sure that they would go on to reach blah, 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 and then it crashed in the spring. All right, the next one, 2008. Guess what? 7 years later, just about on time with that 4 to 7 year average. What was it in 2008? Well, we call that one the subprime mortgage crash. And why did we call it that? Because there had been a boom before that, in which the boom was supported by a rapid increase in lending to people to buy their own homes, particularly people whose credit would never have let them get such a mortgage loan before. But now the mortgage loans were literally pushed on people, many of whom, by the way, lost those houses in the years right afterwards, and the economy dropped like a rock. It was so bad in 2008 and 9 that we called it the Great Recession in honor of the fact that it looked like the Great Depression of the 1930s. Okay, that was in 2008 and 9. Then in 2019 and 20, we had the so-called COVID-19 crash, another 7 years or so after the subprime mortgage one. And I won't repeat myself, the same thing. Okay, here we are. The last crash was in, I don't know, 2020, let's call it. So let's add 4 to 7 years. Ooh, we're right there. We're at the end of 2025. And so that's 5 years. Could happen any time. So everybody's primed for it. And then we're watching the stock market kind of go very big high. That's why we're talking about Mr. Elon Musk, who has 200, 300, 400 billion dollars. He doesn't actually have that money. He owns shares of stock that have risen in price so that he has that asset value. And his company is so confident that the Tesla will be the electric vehicle of the future that they just finished offering him a 10-year contract for $1 trillion. The richest man on earth now gets the richest offer on earth ever made to anybody to run a company. These are frothy signs of exuberance. Now, let me give you some statistics. I'm an economist, so bear with me. I'm going to give you statistics of the last 5 years, the 5 years since the last crash. All right? 5 years ago, the Dow Jones stock market, that's one of our big stock markets, had an index, Dow Jones in it was 28,000. Today, it's 46,000. Less than double, but that's an impressive move in 5 years. Now the NASDAQ, that's actually the larger stock market we have in the United States, the most important one. Its index in August of 2020 was 11,000 at a level. Its index today, 22,000. It doubled. And finally, the Standard & Poor 500, the 500 biggest corporations in America, their index 3,000 in August of 2020, 6,500, more than double in the interval. These are crazy. Nobody's incomes doubled in those 5 years. Nobody's prices doubled. These are out of the world. What's going on is that the stock market is the place where prices are going up. People are buying each other's stocks. 10% of the richest people do 80% of the stock trades in this country. They own 80%. So we're talking about the playground of the richest 10%, who buy from each other, and in each transaction they bid up the price so that they all are looking at the rising price of their shares. But what has it got to do with the underlying economy? Answer: nothing. It's disconnected. It's a frothy gambling casino in which the people are drinking more and betting more and collecting their chips, and they're so happy. It's chips. It's not food, it's not clothing, it's not shelter, it's not output, it's not world trade. It's none of the things that make the economy real for most people. It makes them very rich. Final statistic, released earlier this week. Half of all consumer spending in America is done by the top 10% of the American people. 10%, the richest 10% do half the spending. The minute that stock market starts to crash, those people will be looking not at a monthly stock statement going up, but they'll be looking at a monthly stock statement going down. And when they do, they will stop spending money. And when that happens, we will have a crash. And what you see in the Wall Street Journal is just people putting that puzzle together and seeing it. Does that allow you to say when it'll happen? No. That's always a question of 8 million factors. But all you need is something, some little event to set off a group of people in the stock market saying, whoa, maybe I better get out now. I don't want to be invested in stocks when they crash. The minute that mentality leads a few people to sell and other people see the market go down, then they will unload, and then you have the total crash of the market, and everybody scratching their heads saying, why weren't we smart enough to get out before it crashed? Which is the same question I've been asked every 7 or 8 years in the history of capitalism. You know, when the market's going up, people love to be enthusiastic, particularly if you're in the top 10%. But when the economy crashes, it's the mass of people who suffer the worst and the soonest. And that's why you have to pay attention, even though no one can give you an exact timing of when it happens. Yeah, well, I think what you're seeing here is what socialists used to call the unplanned character of the capitalist system. Nobody sits down and makes the rational calculation. Here are the number of people coming out of our university system with advanced degrees. how do we make sure to get the maximum contribution to the society from these people? They want a job and we need their productivity. So let's do this in a nobody does that. The government doesn't do it, the universities don't do it, nobody does it. We are supposed to leave it to the market. Okay, well, here's how the market works. Jobs are created if and when it's profitable to do so. That's the rationale. Americans don't want to face it, but we have a system that holds employment hostage to profitability. You get a job if it is profitable. If it isn't profitable, you don't get a job. We don't get the benefit of what you could contribute. The irrationality screams at you here. 4.3%, the size of the American labor force now is about 160, 170 million people. 4.3% is 7, 8, or 9 million Americans who are out of work. And these numbers are minimum undercounts. The Federal Reserve tells us that 1/4 of the industrial capacity to produce is sitting idle. That's the Federal Reserve. So we have 1/4 of our factory space, office space, store space, machines, computer. It's all sitting there doing nothing. And we have millions and millions of people who want a job, and a society that could solve enormous problems by putting the people who want a job together with the capacity that isn't being utilized. There goes your poverty problem. There goes your center cities that are not bustling. You could rebuild it. It's all doable, let alone what you might do for the rest of the world, so they would like the United States rather than taking a step back, which is what we're doing to the world now. It is astonishing that we have these kinds of numbers, and it is sad that the people who publish the numbers so rarely explain to the people what the numbers mean. But then again, that's our job.